Hello again and welcome to Money Tips. This is Charles Kelly. Today I want to talk to you about debt, and hello and hi to everyone on Facebook Live. Thanks for tuning in, everyone who does tune into my regular Facebook Live broadcast. Great to see you and hope you're having a good day. And thanks for everyone who listens on my podcast, which can be found on iTunes and Stitcher and on my website, moneytipsdaily.com. Now, many of you might think, well, you see me talking here about money. What does he know about money, you might say? Well, let me tell you a bit more about my story. When I was growing up, we didn't have any money. We lived week to week based on, my dad's cash wages. In those days, people got paid weekly in cash. Do you remember that, cash? Is anyone old enough to remember receiving a cash pay packet, a little brown envelope, not the size of a normal envelope, but maybe that size of an envelope, not much bigger than your phone, and in there you'd get cash. And robbers used to have wages snatchers and that sort of thing. If you see the old movies, they had a wages snatch. Well, now hardly anybody gets paid in cash, but in those days it was cash. And if the father of the house was irresponsible, he might go out and spend that cash in the pub. He might go and gamble it. I mean, my dad was a bit of a gambler, and many times he did gamble money away before my mum could get her hands on it and use it for things like paying rent and food. And so we lived week to week, and it was a precarious situation. We didn't have credit cards or overdrafts, so we didn't have that thing where we could smooth out the peaks and the troughs. And anything we did buy, we had to buy using very expensive credit. Now, mum handled the money. Dad wasn't so good with money. He liked donating his money to sick animals called racehorses that never won a race. In fact, some of them are still running. That's the old joke. What's the old joke? He put money on a horse at 10 to 1. At 2:30 it was still running. That's the old joke. Okay, enough of those. Now, if Mum wanted to buy something for kids' Christmas toys and that sort of thing, there were 4 of us, she had to put aside a little bit of money, maybe in a jar or something, to save for that, because you couldn't just go out and pull out your credit card, and it was tough. She didn't buy herself any luxuries really, and a lot of the food we had, the clothing we had, was bought second hand in jumble sales and that sort of. I'm not saying this to sort of get the violin out. I mean, I had a fairly happy childhood with a lot of kids around. We could go out and play in the streets, unlike now. We could go and kick football around, but we definitely didn't have money. And it was difficult when you had to really pay everything at top rate, even though you were the people who had the least money, but you paid the most for virtually everything. And that doesn't seem fair to me. And things like, I don't know, we're always behind everything. We're always behind with the rent. We were behind with things, and we'd have the rent arrears officer coming round and, asking when you're going to pay your rent and that sort of thing. And anything we bought, like you'd have these guys called tallymen that would knock on the door and sell you stuff. It's kind of from a catalogue really, but they would deliver it, and they would have stuff in their cars, and they had cars, and they would knock on the door and say, do you need shoes, do you need clothes, do you need this, and they would sell you stuff, but then come and collect the money every week. So it was providing a kind of service, I guess, because people didn't have the cash to buy things. But on the other hand, you were paying more for those goods than you would going to buy in a shop. And then you were paying very high interest rates. And nobody really calculated the interest rate on these things, but they could have been 40, 50, 60, 100, 200%. I don't even know. And these companies became rich by selling overpriced goods to the poorest in society. One of them was, like the catalogue companies, the Moores family, who owned Liverpool at the time. There were families that, really got very, very wealthy, selling stuff to the poor, but not at cheap rates, but at higher rates, and charging high interest rates. And this still goes on today. Mum shopped for food every day, so she had to go to shops. She couldn't go to a shop and buy a month's supply and put it in the fridge because we didn't have a freezer or a freezer. So we kind of paid everything at top rate. We didn't have proper banking facilities. She had a post office account, a savings account, but we didn't have access to a checkbook and credit and that sort of thing. There were always arguments in the house about money because, Dad would say, well, I haven't got any money. Where have I got money? And she'd say, well, you've always got money for the bloody bookies. and there was arguments going round and that sort of thing. All Dad wanted was a car. We didn't have a car. We had to travel over on buses and trains, and we were the poor relations that would turn up at weddings by bus, and we'd be late. And then when they moved from the church to the hall a mile away, everyone would get in their cars, and we'd be standing there saying, "Who's going to give us a lift?" It was embarrassing. So it caused a lot of stress, and all Mum wanted really was a little house for herself. She didn't want to keep paying rent all her life. Now, Dad never got his car, unfortunately, but she did manage to buy a house from the council because Margaret Thatcher, the former Prime Minister in the 70s, gave people the right to buy their council homes. And that was the biggest social step upwards, I think one of the biggest in history, in fact, that it enabled people to go from renting to owning a property. It was one of the biggest social upward mobility policies of all time, I think, and it helped millions of people. Okay, there's been problems since that they didn't build enough council houses to replace them, but it got people on the housing ladder, and they were still housed. They're in a house. The house is not empty, right? So anyone who criticises that policy should think again. Now, most people say that money doesn't buy happiness, but how can you say that? A little bit of money would have helped us immensely. And, a lot of people are not living week to week. They're living day to day. They're living like literally, they go out in the morning. I've been to the Philippines where, a driver drives a Jeep all day just to buy food for that day. Or someone goes out selling stuff during the day on the side of the street, selling chewing gum just to make enough money to live that day, to feed the family that day. And if they don't work that day, they don't eat. So people were worse off than us and still are. Nowadays people don't live week to week in the UK and in first world countries, but they maybe live month to month. They get paid monthly, but it's still a precarious existence. They're still maybe only a couple of months away from potential bankruptcy. If you think of bankruptcy as being not having enough money to clear your debts or having more debts than assets, then many people are already technically bankrupt, but they just don't go down and declare themselves at the bankruptcy court. But they're maybe swimming in what I would call a sea of debt. Yeah, money can make you happy. And that's why I wrote this book. Yes, money can buy you happiness, because money can't buy you happiness. But most of those people have got loads of money. If you talk to Lord so-and-so, money doesn't make you happy. I've got all this land and that, but it doesn't make me happy. Oh, yeah. So, well, try giving it up and living in a council flat. Then see if that makes you happy. Or try living in a country where you live day to day. And then tell me that money doesn't buy you happiness, because it's cobblers, it's rubbish. Money can and does buy you happiness. Not the pound notes itself. Not, money is making me happy. Look at this. Not that. But what money can buy? It can buy you security. It can buy you freedom. It could have bought Dad a little car to run around in so that we could go out on family days and drive to the beach instead of trying to get 4 trains. It can buy a little bit of security to have your own place. It can buy just that little bit of happiness to know that you're not struggling and you can pay your bills on time. They were always struggling, and it created a lot of stress in the house. The stress came down like a process of osmosis to the children. Even little kids can feel the stress of their parents. You can see it in supermarkets when parents are shouting at kids, "No, you can't have those sweets. No!" And there's tension there. There's aggravation. There's stress. When my son lost his football boots at school, there was so much stress over that. But other parents would just say, "Don't worry, have another pair of boots." But we were shouting at him, "Why? How could you be so stupid to lose those boots?" And he was already upset losing them. And, then we had to buy him a really cheap, nasty pair of boots, almost to say, "Well, there you go. You lose your boots. That's what you get." Did we need all this stress? No, there were a pair of boots that, cost a lot of money, but to us, they were a lot of money, but they weren't really a lot of money. So a little bit of money can make you happy. Don't believe this, money can't buy you happiness, because yes, money can buy you happiness. And if you know how to manage your money, you can be happier. That's a fact. If you follow the steps in here and know how to manage your money, you will be happier, because you'll have less stress over money. If you know what your money thermostat is, like in a room where you have a thermostat set at 21 degrees, what happens when you open the door and cold air comes in, right? What happens? The temperature goes down, so the heating kicks in and makes the room warmer again to 21 degrees. But then if the room gets too warm, like you have more heat in the room, more people, then it gets above 21, then say, "Oh, we're going to switch the heating off." It's a bit like that with money. Sometimes people have this thermostat that they think they can only have so much money. So if they come into a lot of money, maybe through a lottery win or through a gift or through some luck at work, or they get a pay rise, they suddenly have to spend it because they've reached their thermostat. They can't handle it. You see this in sales when a salesman who's maybe making X amount per year, he's making 30,000 a year, and that's all he can sell, that's all the commission he can make because he's reached his limit. Then suddenly he might have a good month or two and he's suddenly on track to make 50,000. But what happens? Then things start to slow down, or maybe he loses a few sales, or things start to go wrong. It's uncanny. I've seen it so many times. And what about today then? So people may be living month to month now, but they're still in the same kind of problems that my parents had, although now they've got a few more tools at hand. But look at this, they still pay the most for credit. They're still getting ripped off by payday lenders and loan sharks, and the banks won't give them proper bank accounts because they don't want those kind of customers. They give them basic bank accounts with a card, no overdraft, no credit cards. It's very difficult. They pay the highest for utilities because sometimes they can't get a monthly account by direct debit. So they have these key cards that they go down to a newsagent and have to top it up. Well, that electricity costs a lot more than if you had a normal account and you can pay by direct debit. So it's the wealthier getting the cheaper credit, they're getting the cheaper gas and electricity, and the poor are always getting screwed. And I see it still today. And, all right, we don't have tallymen, but we now have shops in poor areas of the country that rent furniture to people. They rent cheap rubbish stuff to people for £2 a week, £3 a week, and charge them rates of hundreds of percents per year if you actually work it out. They rent toys for their kids. And it's tragic, really, because people are just sort of stuck in that mentality. Their thermostat says, yeah, that's what my mum did, that's what I do. I'll go and rent a fridge, I'll rent a TV. So they go home with this big TV. They think, great, I can have this TV for £3 a week. But it's costing them a lot more than they even know. So it's still the same wealthy companies feeding off the poor in a way. Now, I don't mind business. I like to do business. But sometimes, you think, is there a morality in this? You've got to look at it. In fact, if you, and I'm going to tell you about a guy that's trying to stop out payday lending in a minute, but if you need to borrow money, why not try a different way of doing it? Go to cooperative banks, go to banks, non-profit organisations, go to what I call credit unions. Now, I'll give you the word of the day, credit union. What is a credit union? Basically, it's a credit union, looks like a bank, but they hold deposits, they make loans, they have cards and checks and that sort of thing, and investment services. But banks are for-profit companies. They make money by charging the highest interest rate they can and paying the lowest interest rate on deposits. But a credit union is a non-profit organisation which is there for the members. It's there for the union members to give them the best services, and you can borrow money at cheaper rates. There are organisations like that. And if you don't know where to find them, Google them. If you can't Google them, go to your Citizens Advice and try and find a credit union. Now, they might not be available in every country, but there are countries that do have, even third world countries have these kind of unions, or lenders that lend small amounts to the poorest of the poor to maybe start a business or maybe fund something, because there are so many people out there out to just take as much money from you as they can. But there are also organisations that are there to help you, and a credit union is one of them. The worst thing you can do is go to a payday lender. When I say a payday lender, it's like somebody that you've got a cheque to cash, and you need the money now, not in 3-5 days' time. And I don't know why the bank still takes 5 days and 4 days to clear a cheque. That is ridiculous. But anyway, that then feeds off these payday lenders who would say, right, I'll cash your paycheck now, I'll give you the cash now, but I'm going to take 5%, 6%, 10% sometimes. So, there is somebody out there that is trying to do something about those, and it's actually an entrepreneur himself. And let me just find his name here. It's somebody called entrepreneur. His name is Peter Briffett, who has persuaded employers, including the restaurant chain Carluccio's and Hackney Borough Council in East London, to allow staff to receive money they have already earned prior to payday. And it's called Wage Stream. The service for which is he co-founded has enrolled 170,000 employers from firms including David Lloyd, Gyms, Bella Italia, Rentokil, and they charge a flat fee of £1.75 to withdraw up to 40% of their monthly wage. And it's an app, and I think it's a great idea. And he said here, we set up in January 2018 to destroy payday loan companies. The worst thing anyone can do is get a payday loan. We know that we're stopping about 3,000 payday loans a day. And this is not a loan, it's not credit. You've earned the right to that money. It's just getting the money quicker. So they're facilitating people to get their money quicker. And good luck to Peter Briffett there. And I hope he does well with that, because definitely something needs to be done about these. And they're in the high street. This is legalised loan sharking in a way. It's still the old system. You know, maybe they've got a name and they've got a credit consumer credit license and that, but it's still ripping people off. And that brings me to the last point, that debt itself is good debt if you borrow to buy assets, but it's not good debt if you borrow to buy liabilities. If you borrow to buy things that take money out of your pocket, like a TV, which is going to go down in value as soon as you walk out the door. So debt, not all debt is good. There is good debt you can use. You can use other people's money to buy properties. You can use other people's money to finance deals that make you money, like a business. But using debt to buy things that take money out of your pocket is bad news. And in fact, people think their house is an asset, that the home they live in is an asset. But yeah, it is an asset in a way, but it's also a liability. It's taking money out of your pocket. So be careful how much you borrow on your mortgage. Now, when I was a financial advisor, because people say, what do you know about money? Well, I was a financial advisor for 25 years. I worked for banks, insurance companies, brokers, and so on. And so I do know a bit about it. And I was an IFA. I was an independent financial advisor with my own business. So this is how I learned about money. I didn't learn about money in school, because they don't teach you anything about money. I learned about it when I joined the financial services industry, and that was where my education started. So I know for a fact that most people don't insure themselves enough. They don't insure themselves against sickness. And in fact, there's a story in the Times today about people in middle class families that are overstretching themselves with mortgages because interest rates are cheap. They're really overstretching themselves. And a charity called Step Change, which is a leading debt charity, has actually helped nearly 10,000 people with incomes above £40,000 last year. So that's not people who are earning tiny amounts of money. That's a pretty good income. And their average credit card debt was £21,000. And while their average total outstanding debt, excluding mortgages, came to £38,000. That's what they owed, like car loans, debts. It's very easy to go and get a car, isn't it? It's easy to go down the road and get a new car. Yes, we'll give you the money. I'll give you the car, just £200 a month. But these debts can all add up. And the charities said that most common reason for middle class debt was a sudden loss of income. And they actually give an example here of a couple where the wife then suddenly got cancer, and he was then working on his own to try and keep things going, but getting into more debt. Then he got sick. Then suddenly, the government wouldn't help him with his mortgage, so he ended up losing his house. He lost his £30,000 of savings trying to keep the mortgage going, lost his house, and then who's housing him now? The government. The local authority wouldn't help him with the mortgage payments. He didn't qualify, but then he ends up in emergency housing and council housing. So they've lost everything, and people just don't think about sickness and what's going to happen. Now that brings me on to one point: PPI, payment protection insurance. There was this big scandal about payment protection insurance, which has now kind of come to an end. But the actual insurance itself wasn't bad. It was that it was missold. It was perhaps sold to the wrong people, not explained properly. So a lot of people got refunds because they jumped on the mis-selling bandwagon. But actually the policies themselves were there to protect people against sickness, against illness and injury and that sort of thing, and unemployment. That was the safety net that they had. So it's probably set back payment protection insurance years now, because I think I'm not even sure anybody sells it anymore because of this scandal that went on. But really, the insurance wasn't the problem. It was probably more the way it was sold. So my tip to you today is to watch that consumer debt. Don't get into consumer debt. Don't buy things that take money out of your pocket. Look after your money, manage your money, learn some of the tips here about money management, the 3 R's of money management, and learn these things and follow them and keep a track on your money so that you don't get into debt. Having a mortgage is fine, but a lot of people then will go on to have a car and furniture loans and this loan and that loan and all sorts of credit, even credit to go on holiday, and then credit cards. And it's so easy with the credit card. You don't even have to put it in the machine now. You just tap it. It's gone. You know, a little tap there. You're much more likely to spend money on a card than you are if you have to get the money out of your pocket and out of your wallet and you're looking at your cash. You think, oh, I haven't got much cash left. But if it's a card, oh yeah, a card. I don't even have to put it in the machine. Tap it. Yes, I've spent that £30. And it just goes on and on like that. So just be careful, because we don't know if interest rates will go up in the future. We don't know how the mortgage market's going to go. We don't know how employment's going to go after Brexit. There could be a downturn. Who knows? Who knows what's going to happen? So that's my tip for the day. Watch that consumer debt and don't get into debt. And if you do get into debt, take advice. Go to your citizens' advice. See how you can manage those debts. There are companies that can help you manage those debts. And if you need to borrow money, go and you can't get cheap overdrafts and credit, then use credit unions and similar organisations to that. So thanks for listening. This has been Charles Kelly, bringing you money tips to help you save, earn, invest, accumulate and enjoy more money. Have a good day and bye for now.